Meantime, Latin America's largest fintech, Nubank, recently hitting the 100 million customer mark. The Brazil-based company recently reported record revenue in its latest quarter. Joining us right now is Nubank's co-founder and CEO, David Velez. And one of the reasons I think so many folks in the United States and around the world, in the world of finance, are fascinated by what you do, David, is that there's a question whether you are ultimately going to be the sort of fintech model for even some of the big banks around the world. But tell us what's going on in your region and explain, given how sort of asset light your business is, if you will, what's happening.
Sure. So we started about 11 years ago with this thesis that, similarly as you have seen in every industry, in every country, technology companies have a significant advantage versus incumbents in delivering a product that is higher quality at a lower cost for consumers. We started in what we think is the best region in the world to do that, which is Brazil. Brazil is a market, very large market, where 5 banks own over 85% of the assets, of the investments, of the credit, very concentrated oligopoly. That meant large percentage of the population did not have access to financial services, and the ones that had access were paying some of the highest interest rates and fees in the world. And so with that digital-first model, we were able to grow for the past decade, and today we are one of the largest financial institutions in the country, crossing over 100 million customers in Brazil, Mexico, and Colombia, and continuously delivering a product that is higher quality at a lower cost, given the low-cost structure. This trend, again, is a global trend. I think there's been peers of us in Europe, in the US, in Asia, going after it. But it's very much still in the first minute of the first half, because when you look at financial services globally, it's the largest profit pool, over $6.5 trillion, but disruptors, fintechs, have taken less than 1% of the market cap. So that story is very much in the early beginnings and is a real structural opportunity that exists really globally.
David, right here in New York City, across the way, there's a Chase over here. I think there's a Chase down there. I mean, we have banks on the corners of streets the way we have Starbucks. You don't have that. Do you need it? And what do you make of the transition to get people not to have to do things in person?
It's very interesting for us to take a look at the U.S. because, in a way, what you've seen in Latin America and Asia is a leapfrog of the U.S. financial services system, in a sense that for 80 to 85% of your financial services products, you actually don't need a banking branch. You can do it all digitally. You can do it in your app. Today, you are paying for the cost of that branch, right? Every single customer is paying for all that real estate sitting in some of the most expensive real estate in the world. Somebody has to be paying for that, and you're doing that through a lot of fees that you shouldn't really need to be paying. And in terms of banking branches, that they're still growing up in the U.S. So to me, that says that you still haven't really seen enough competition in the U.S. in that space. And the moment that somebody come in with a model that has a cost structure advantage of over 80%, which is our case, just to give you a sense, we have 100 million customers with 7,000 employees. Our competitors have 100 million customers with 110,000 employees. So the cost structure advantage is huge. That cost structure advantage should also exist in markets like the U.S. and eventually will be really important for to compete.
David, speak to this. You've just had record revenue in this last quarter, but you have an increase in delinquencies, and I want to try to understand what you think is going on, both at Nubank itself, but whether you think it speaks volumes about what's going on in the region.
Sure. So we see a seasonality increase in delinquency really this quarter that we released yesterday. Is very much as expected. You generally see higher delinquency in the first quarter of the year after a December and a November where people increase purchase volume a lot. So it's really very much under control on the delinquency side. What's important for us is that every single loan that we give, it has to be NPV positive. And so if we're seeing high delinquency in certain areas, we have to be compensated for that additional risk that we're taking through pricing that risk effectively. And that has always been our methodology. That's why we generated record earnings of over $440 million last quarter, and return on equity of 23%, which is one of the best in class in Latin America, even though we see that delinquency ticking up.